Hi, I'm Michael Joyce with JoycePayne Partners, and I'm pleased to share with you our thoughts and viewpoints for the winter of 2018. We are just coming off a blockbuster year in the stock market, and really all the world's markets really did pretty well during 2017. The reason for that is that the U.S. economy did really pretty well, and global economies did well. And that's not something that always happens, that happens in sync. So therefore, corporate earnings really saw a boost and stock markets really rose around the world. And almost every asset class was up last year. So returns were really very good. And we're very pleased with our client returns. But I often get asked the question, how long can this continue? And it can continue for a while, but we really don't expect realistically to have the kinds of returns that we had in 2017. But that doesn't mean that returns for 2018 will be negative. We could still have positive returns for 2018. The things that are really helping are the fact that there is a lot of momentum in the world's economies, and that is pushing some things along. But stocks are not cheap right now. And we do believe that there is going to be a correction at some point. And I always make sure to say that we're going to have a correction at some point, because whenever it occurs, I'll still be right. But realistically, I've been saying this for about a year. We don't know when a correction could occur, or indeed what could cause it. But if a correction does occur in the near term, we don't think it's going to be the beginning of a bear market or the beginning of a recession. The economy just has too much momentum at this point in time to turn around that quickly. But that doesn't mean we shouldn't be worried about things. And one of the bigger things that we're worried about is if interest rates would rise unexpectedly. We're not saying that this is going to happen, but it could. Labor markets are really pretty tight right now, which so far has not resulted in wage inflation. There are real wage increases that are going on, but they're kind of muted. Despite the low unemployment rate, the quits ratio is not very high. And the quits ratio is where people would say to their employers, basically, take this job and shove it. And they're just not doing that. And so that means that they don't have the confidence that they could just run out and get another job at a lot higher pay. And as long as that quits ratio is low, we don't think we're going to see high wage inflation. But again, it's something that could change at any time. We also have to look at the fact that our interest rate environment is not just with the US. We live in a global environment. So the interest rates in a lot of the other developed economies are still pretty low. For example, the interest rate on the 10-year German government bond is about 0.5%. So rates on U.S. bonds can't really rise that far to get out of sync, or else there's going to be buying and selling, which will bring that back into equilibrium. And because valuations aren't cheap right now, we think it's a good opportunity to harvest some profits that have occurred over the past year and a half. And these are on some stock positions that have really risen quite a lot. In most cases, they are positions that we still expect will do well over the long term, but they're pretty fully valued right now. So it makes some good sense to prune those positions. On the other hand, not everything has appreciated as much as the markets. So we're also on the lookout for some things that might be some good values that might have some good appreciation potential. As I mentioned before, interest rates, we're worried about that, and they have moved up a little bit. The long-term interest rates just very recently have moved up a little bit. But shorter-term interest rates have moved up a little bit more. They're governed more by the Federal Reserve, which has increased the discount rate a couple times during 2017 and is expected to do so again in 2018. And the Federal Reserve has much more control over short-term interest rates than long-term interest rates. So we want to start thinking about not just the asset side of a person's net worth statement, but also the liability side. For people that have things like home equity lines of credit or credit card debt, or really anything that is tied to short-term interest rates, they're going to start to see those rates rising and see some of their interest costs rise at this time. So I think it's a good idea to get together with your financial strategist at JoycePayne Partners and talk about both sides of your net worth statement and see how to optimize that. Now, one of the big things that also occurred right at the end of 2017 that's going to have a big impact in 2018 is the new tax bill that was passed. And there's a lot in it. Like a lot of other people, we're still trying to get our heads around everything. But as we're going through it, we're finding that some of our clients are going to pay a little bit less in taxes, some people are going to pay a lot less in taxes, and some people are going to pay more in taxes. It really depends on the situation. On average, we think that our clients are going to pay a little bit less in taxes. And there's really some significant changes. I mean, the standard deduction is doubled, so that's going to change for some people that itemize their deductions. Miscellaneous deductions go away. The deduction for state and local income taxes and real estate property taxes are limited. So those things will have an impact. But on the other hand, the threshold limit for the alternative minimum tax was raised significantly. So a lot of our clients who had previously been subject to the AMT, or the alternative minimum tax, will no longer be subject to AMT, at least not for the foreseeable future. And again, this is a good opportunity to get together with your financial strategist at JoycePayne Partners and see how the Tax Act is going to impact your financial situation and see if there's any changes that should be made to optimize your situation. I mentioned last quarter that JoycePayne Partners is going through a branding initiative to coincide with our firm's 25th anniversary. And I'm happy to say that we've made a lot of progress on this. In the next couple months, we will be unveiling our new brand, which we're all very excited about, and we'll have a number of activities that will go along with our 25th anniversary. So stay tuned for that. So I've been very pleased to share with you our thoughts and viewpoints for winter 2018. If you want to know more about our viewpoints, please contact your financial strategist, or you can go on our website, JoycePaynePartners.com, or follow us on Twitter at JoycePaynePTRS. So thanks a lot. Have a great day.